It's just not worth it any longer to park a tremendous amount of your savings in US dollars and US debt. That's a fact. And it's only going to get worse over time. The 490 stocks in the S&P 500 haven't grown their earnings at all in the last couple of years. It's just those 10 stocks. Those 10 stocks have the highest concentration of ownership ever. When the plug is pulled, there will be a very narrow exit door. So you have to identify it ahead of time.
You're watching Silver News Daily. Subscribe for more.
The United States is now paying over $3 billion a day just in interest. Let that sink in. This isn't some developing country caught in a financial death spiral. This is the world's reserve currency issuer. And yet, with $37 trillion in total debt, and while $14 trillion of it added since 2020, the U.S. has officially crossed the line into what Michael Pento calls a banana republic. It's not an exaggeration anymore. It's a mathematical certainty. The debt bomb is ticking louder by the day, and when it detonates, the fallout won't be measured in GDP, but in silver ounces. Because while the media distracts the public with stock market highs and tech hype, something much bigger is brewing under the surface. The cracks in the dollar's foundation are now visible, and faith in the currency is evaporating fast. Inflation remains sticky, the Fed is trapped, and the only thing keeping the entire illusion alive is more debt, more printing, and more desperation. But here's the thing. Investors aren't blind. They're watching this unfold, and they're already moving their wealth into hard assets, into silver, and not just any silver, physical silver. Where premiums are climbing and supply is running dry, analysts are now forecasting prices that could break past 50 pounds, even push 100 pounds. And if Pento is right, we could be staring down a trajectory toward about $500 an ounce as the stock bubble bursts and the dollar unravels. The signs are everywhere, the data is clear, and the time to act is vanishing fast. So how did we get here? And what exactly is about to make silver explode like never before? Stay with me, because this story is only just beginning.
Well, I've been predicting for years that the U.S. would end up being a banana republic. Actually, I think it's now decades I predicted this. And as I said recently in a commentary, we're no longer predicting that. We're just saying it's here. It's here. You got the $37 trillion in debt, $3 billion in interest payments every day. The debt is up $14 trillion since 2020. This is insanity beyond belief. The deficit for July was $291 billion. That's the second largest deficit for the month of July in U.S. history. Now, this is happening in the context of pretty much full employment, we're told, and a healthy economy, ex recession. So we're a banana republic. Not only that, but some developments I've seen lately with the administration, who, by the way, I always say this because people will accuse me of being anti-Trump. I did vote for the man, and I think he's infinitely better than Kamala Harris would ever have been on her best day. But I'm sure I'll offend everybody when I say I don't like what he's doing with the Bureau of Labor Statistics or with the Federal Reserve. There's some significant trenchant problems with both those institutions. But it's the opposite of what the president is railing against. So, for instance, the BLS persistently overestimates the number of initial jobless jobs numbers. And they underestimate initial claims perpetually. And then they go back ex post and revise them much lower. So if you wanted to damage the administration, what you would do is when everybody's myopically focused on the first Friday of every month, they would put out a really bad number and revise them higher. Listen, I'm apolitical. I just want to make money for my clients. I'm just trying to be honest here. So I'm not a political hack. So when the president does something good, I'll support him, and he does something egregious, I'm going to call him out on it. Likewise, he's railing against Jerome Powell, and the salient issue there is that he's not cutting interest rates fast enough. But the problem with the Federal Reserve isn't that it's perpetually over supplying the public with a positive real interest rate. The problem with the Federal Reserve is that it's chronically produced negative real interest rates. And for the last 20 years, most of that time, it's been a nominal rate that's been close to zero. And real rates profoundly negative. So if you want to pick up...
Since 2020, the United States has added a staggering 14 trillion to its national debt. That's not just reckless, it's suicidal for a fiat-based economy. And with total debt now ballooning to 37 trillion, the very foundation of the dollar is crumbling in plain sight. The debt isn't just a number on a spreadsheet, it's a parasite draining the life out of the entire financial system. Every new dollar borrowed accelerates the decay of purchasing power, driving investors to seek safety in anything real, tangible, and limited. That's why silver isn't just rising, it's being hunted. As the interest payments snowball, already exceeding about $3 billion daily, confidence in U.S. fiscal discipline is vanishing globally. And when confidence dies, so does the currency. The Treasury is running trillion-dollar deficits just to stay afloat, borrowing to pay interest on what it already owes. This isn't fiscal policy, and it's a death spiral. And the world is watching. Nations are de-dollarizing, central banks are reducing exposure, and smart money is front-running what comes next. A full-blown currency crisis. The U.S. dollar's dominance depends on trust. Trust in the government's ability to manage debt, inflation, and long-term stability. But every passing quarter tells the same story. No control, no accountability, and no way out. So where does capital flee when the world's reserve currency starts to die? Into scarcity, into metals, and silver, already outperforming gold by over 10 this year, is becoming the escape hatch. Because while gold is expensive and tightly held, silver remains cheap, accessible, and massively undervalued relative to both history and gold itself. Investors aren't waiting for headlines. They're already shifting, and the dollar's accelerating collapse is forcing that shift into overdrive. But the Fed isn't just watching this unfold, they're cornered, and what they do next could set silver on fire.
Fight with the Federal Reserve. I'm in the vanguard. If you want to pick a fight with the BLS, I'm in the vanguard. Totally needs to revamp, but for the opposite reasons of what the president's saying. So, when you think about Banana Republic, you think about Banana Republic, you can't trust the data, the country is bankrupt, and the central bank works at the behest of, is a sycophant of the administration. So this is where we're headed. And you asked me, I'm going to answer your question in a very long, so thank you for giving me a little more rope. But I want to make sure the viewers get what they're paying for here. Their money, get their money's worth. I'm still long the market. I'm net long. I am not net short. We've got precious metals and we've got some foreign stocks. We've got defensive stocks. We're long the market, participating in this bubble, but the bubble is absolutely ready to crack. And I can quickly give you two reasons why I think the fantasy is almost over and reality is going to hit. So I will give you these two reasons. Number one, the labor market is fracturing and the economy is weakening. That is undebatable. Everybody understands this. This is not under any kind of this is something objectively true. So if this continues, and I have every reason to believe that it will, what if the Federal Reserve is not going to cut rates significantly in the manner that is needed to support an eroding economy, an eroding earnings per share, and woefully disappoints Wall Street just because Powell just cannot cut interest rates when you get inflation numbers like we did today on the producer price index, leaping way over 3%. So that would cause the market to sell off. But I think a more likely scenario is we do get significant rate cuts, either by Jerome Powell or whoever he or she is going to replace him, an obsequious sycophant, as I like to say. That's a May 2026 story. And when they cut interest rates, the same function will happen as what occurred in 2024. So the Fed cuts the Fed funds rate. That's the rate that's applied to money markets, and long-term rates spike. Exactly what happened in 2024. In that case, in this case, if the Fed is going to cut rates aggressively, when inflation is waxing further away from 2% and really crushing the middle class even further, the bond market, investors might lose all confidence in the bond market. And then you have spiking rates on auto loans, student loans, corporate debt, and mortgages. So that would cause the market to crash even faster and further.
The Federal Reserve is trapped, and everyone knows it. After years of rate hikes to tame runaway inflation, the consequences have finally caught up, and in September 2024, the Fed caved. With inflation still running hot, they cut rates for the first time since 2020, slashing the federal funds rate back down to 4.75, 5.7%. The result? Silver prices shot past $31 an ounce, almost overnight. Because the moment the Fed pivoted, the market understood the truth. The era of tight money is over, and the dollar is on life support. This is the impossible situation Michael Pento warned about. The Fed can't hike rates anymore without risking total collapse in the bond market. But cutting rates? That's like pouring gasoline on an already burning inflation fire. Either path leads to disaster, but only one of them sends silver soaring. And the Fed just chose it. Now, the conversation isn't about if they'll cut again, it's about how aggressively. With inflation refusing to fall below 3% and new tariff threats looming, the Fed has no real tools left. The bond market is already flashing warning signs, and if long-duration yields spike while the Fed is easing, faith in treasuries could collapse. That's the nightmare scenario for the dollar, and the dream scenario for silver. Because when real interest rates turn negative and the dollar weakens, silver becomes more than just a hedge, it becomes a necessity. Unlike stocks, bonds, or even real estate, silver isn't built on debt or trust. It's built on scarcity and intrinsic value. And as capital flees the system, silver becomes the safest form of financial escape. Investors are watching this unfold in real time. And while Wall Street is still drunk on tech hype, the smart money is already positioning for what happens next. And it starts with physical silver. Not paper contracts, not ETFs, real bars, rounds, and coins, where premiums are rising and supply is tightening by the week.
About 4.5% in platinum and 4.5% in gold. And I'm looking to increase that, but not at this moment. Listen, the bull market in gold is not exactly something that's a secret. It's outperformed the S&P 500 for the last 25 years. So it is a very long and protracted bull market. And the reason why I own 5% of it and not less, you have to have some. And I'm talking about liquid paper gold. I'm not talking about, I've always recommend you get 5% physical gold in your possession. You start there. And that's something that's an heirloom for your progeny. But if you want to talk about liquid paper gold, it's right now 5% because we have an insolvent nation with a currency that's weakening, and not only weakening against other flawed fiat currencies, but weakening against hard assets. I expect that to increase in a dramatic fashion next year. The only thing that gives me a little reticency about this is like if I said before, if the long end of the bond market really becomes intractable and rates begin to spike, it is going to hurt gold as well. Not as much as it's going to hurt Bitcoin, and not as much as it's going to hurt the S&P 500 and the major league tech. I mean, that's where the big bubble is in that Mag 7. That's where everybody is sequestered, and the Apple, the Google, the Amazon. And because they're market cap weighted index, you have passive funds just flowing into those stocks, and they become so. If the 490 stocks in the S&P 500 haven't grown their earnings at all in the last couple of years, it's just those 10 stocks, and those 10 stocks have the highest concentration of ownership ever in relations with the other 490. So you have a massive bubble that when the plug is pulled, there will be a very narrow exit door. So you have to identify it ahead of time and get out. And as I said, this is a Thursday evening recording. This is not the case right now. I'm not out of the market. But if you wanted to try and get, and I'm not gonna guess today and hold myself to it, because I'm working every day. I don't have to hold myself to some kind of commitment to sell and set at the start of September. But an appropriate time frame, given the seasonality, and given what's happening in the next few inflation reports, according to my predictions, that inflation is going to run hot, both on PPI and CPI. And the fact that I believe the Fed is not going to cut rates by 50 basis points. You had Treasury Secretary Besson come on the other day and call for, and he did say it, I know he tried to walk the comments back today, but he wanted a 50 basis point rate cut immediately and 150 to 175 basis points in cuts in total. In a rather short duration. You'll wreck the dollar and you'll wreck the bond market, and I believe if you do that, it's all over for stocks, and you better be on the vanguard, monitoring those systems very closely, because you're gonna short circuit your retirement if you don't.
Silver is no longer just climbing, it's accelerating, and physical demand is leading the charge. In 2024 alone, silver prices exploded by over 43% and pushing past $35 an ounce, outpacing gold by a wide margin. But what's really sending shockwaves through the market isn't just the spot price, it's the awesome premiums on physical silver. Investors aren't waiting around for Wall Street's green light. They're buying up rounds, bars, and coins at increasingly higher prices above spot. And still, supply can't keep up. Think about it. When was the last time silver premiums surged this high without a major financial panic? It's not happening because of fear. It's happening because of fundamentals. The physical silver market is being drained at a rate that even seasoned metals dealers are struggling to handle. Online inventories are thinning. Wait times are growing, and yet demand shows no signs of slowing down. Why? Because this isn't speculation. It's survival. As silver inches toward its 14-year highs, forecasts for 2025 are turning downright explosive. Analysts are calling for prices to break 38 pounds, even touch 50 pounds within months, driven not by hype, but by bars math. Demand is rising, supply is flat. And when you factor in a weakening dollar, falling real yields, and collapsing confidence in financial assets, silver becomes the most obvious play on the board. And this is just the beginning. Every dollar printed, every rate cut announced, and every inflation report that misses its mark drives more people toward physical silver. The COMEX may set the paper price, but the real market is happening in vaults, safes, and delivery trucks. And right now, the premium tells a story loud and clear. But what happens when the world realizes that silver isn't just facing demand pressure, it's also running out fast?
My transactions are not anonymous, they're immutable, and they're decentralized. None of those things are the case when you have the cryptocurrency tied to the US dollar and to the US Treasury complex. Everybody knows who you are, they know that you own it, and they're tied to the dollar, which would, I thought these things were supposed to be rare and the protection against a falling dollar. So it's completely antithetical to every, supposed reason for these cryptocurrencies to have value in the first place. So that's my thought. I mean, if you're going to own a cryptocurrency, why would you tie it to the dollar and to a treasury bond? It doesn't. I think the demand for these assets is way overblown. It's going to underwhelm you significantly. I manage lots of money and I have lots of friends in the business. I don't know anybody who's interested in this. Really, it's a very arcane, small demand, and it's not going to give a lot of supply to treasuries. I don't think so at all.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. Silver production is hitting a wall, And that wall isn't moving. Global mine output rose by less than about 1% in 2024, barely reaching a Glasgow 19.7 million ounces. And most of that growth came from byproduct mining, not direct silver extraction. That means we're not discovering new silver mines. We're scraping what we can from gold, zinc, and lead operations. And while demand is breaking records, the supply side is stuck in reverse. Mines are aging, regulations are tightening, high-grade deposits are vanishing, and in key producing nations like Chile, output is actually falling. This isn't a temporary bottleneck. It's structural, and it's deadly for price suppression. We're now heading into our fourth consecutive year of a global silver deficit. The Sacher Silver Institute expects the 2024 shortfall to hit on 215 million ounces, a gap that's becoming impossible to ignore. And there's no cavalry coming, no massive new discoveries, no breakthrough supply sources, just rising demand and shrinking availability. The kicker? Most silver miners don't even specialize in silver. Nearly 70% of global supply comes from operations that mine other metals. That means silver production isn't just limited, it's unpredictable. It can't scale the way gold or copper might. And that's a ticking time bomb, because while industrial demand surges and investors grab physical at any price, there simply isn't enough new metal entering the system to fill the gap. And when you combine that with exploding monetary demand driven by inflation and currency instability, the setup becomes almost too perfect. Prices are being forced upward not by hype, but by scarcity. And that scarcity is about to face its biggest test yet, an industrial boom that could devour the remaining supply even faster.
Well, it's already happened. That's not a prediction. That's a fact. So if you're a foreign holder of U.S. debt, and then all of a sudden you're capriciously subject to sanctions and tariffs and confiscations, well, you know that's happened before. So you're very cautious right now. But another dynamic that's happening is that since we're seeing this chaos in the tariffs front, then if you have the idea that all of a sudden your tariffs go from a level of 2% to 16% on average, and in some countries they're arbitrarily, capriciously raised to 50% like India because you're buying Russian oil, you start thinking to yourself, wait a second, I'm going to have a much lower amount of trade surplus that I need to recycle into the U.S. bond market. So that's another dynamic that's happening. So the final nail in the coffin, though, is going to be the insolvency and inflation of the United States. We're headed, like I said, it's banana republic. I think we've arrived. And you're just not going to be willing to park your money in a 10-year treasury note. If you could buy a Japanese note in your, if you're a Japanese citizen and you can get 3% on a 30-year, 40-year bond, and you don't have to worry about currency fluctuations, well, then you just go and buy your own domestic debt. That's an option that Japanese haven't had for a long time. And that's the case in a lot of parts of the world too, Dunnigan. It's just not worth it any longer to park a tremendous amount of your savings in U.S. dollars and U.S. debt. That's a fact. And it's only going to get worse over time.
Silver isn't just being hoarded, it's being consumed at record-breaking speed. In 2024 alone, 680.5 million ounces were swallowed by industrial demand, an 11% year-over-year surge that's showing no signs of slowing. And the lion's share of that demand, it's not coming from investors, it's coming from the energy transition. Solar panels, just alone now, devour 232 million ounces, nearly 1/5 of global demand. And with government mandates pushing net zero timelines into overdrive, that number is only going one direction, up. But solar is just the start. Electric vehicles are ramping up at a speed that even automakers can't keep pace with. By 2030, EVs are projected to dominate more than 60% amount of auto markets in major economies, and every single one of them is packed with silver, from inductive charging coils to advanced power electronics. Then layer in digital AI infrastructure and next-gen semiconductors and the rollout of our smart grids, all of which rely on silver's unmatched conductivity, and you start to see the bigger picture. This isn't demand based on speculation, it's structural. And unlike gold, silver gets used up. Once it's embedded in a solar cell or buried inside an EV circuit board, it's not coming back. Recycling is expensive and inefficient. That means every new megafactory, every solar farm, every EV rollout is silently shrinking the available pool of silver. And here's the real danger. These industries can't pivot. There's no substitute for silver in high-performance electrical applications. It's not optional. It's essential. So as supply contracts and investment demand accelerates, industrial buyers are being pushed into the same narrow corridor. Everyone's scrambling for the same shrinking pile of metal. This is no longer a supply chain issue. It's a full-blown allocation war. And while industry and investors battle over dwindling ounces, another silent trigger is being primed: the collapse of the stock bubble. And when that goes, silver could become the only safe exit left.
Well, there's the way I see it real quickly, because I know we're running out of time, but there's two outcomes, and they're both very bad. We're either Japan 1989, where you have a deflationary bust and asset prices crash, and they still haven't come back to where they were 35 years ago, 35 years later. So that 36 years now. And by the way, Japan's GDP growth in dollar terms is lower today than it was in 1989. No growth. So that's one possible outcome. And that's the better of the two outcomes. And the other outcome is Weimar Germany, Hungarian Pento, Zimbabwe. That's the other possibility. Or Rome. Just Rome was, you can't. Well, okay. Was Rome a banana republic? No. Did Rome have the world's reserve currency? Yes. Did Rome have 1,000% inflation in the dinar? Yes, it did. So don't tell me the dollar can't crash, and don't tell me the interest rates can't spike. I hear some people, very smart people, who wrote some books about the collapse of leading up to the global financial crisis, saying, "Oi, the deficit." I think this person says, "Oi, the deficit." Oi, the deficit. Well, because he says that the dollar's strong and there's no alternative to owning the most liquid market on the planet. Okay, that's wonderful. But didn't the 10-year note yield go to 15% in 1980, in 1981? And where is it today? 4.5. So good, we have the world's reserve currency, and we have the most deepest and liquid bond market. But that doesn't mean interest rates can't spike to 15%. And the conditions today are much worse than they were in the late 70s or early 80s. The debt to GDP back then was like 35%. And now we're 123%. We didn't have $2 trillion deficits, 6% of GDP back.
The stock market is a house of cards, and at the center of it is the Mag 7: Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, and Alphabet. These 7 giants have driven the bulk of market gains, distorting valuations and creating one of the narrowest, most dangerous bubbles in history. But here's the truth no one wants to admit. When this bubble bursts, there won't be a wide-open exit door. There will be a stampede. And silver? That's where the smart money will run. Michael Pento calls it exactly what it is, a very narrow exit door. Because when confidence in these tech darlings evaporates, when earnings disappoint, or inflation refuses to die, or geopolitical chaos hits the system, billions of dollars will try to escape risk all at once. But where can they go? Bonds are unstable. The dollar is deteriorating. Real estate is vulnerable. The only place left? Hard assets. And silver is primed. Unlike gold, silver has yet to catch up. It's still lagging far behind its historical highs, even as its fundamentals grow stronger by the day. And when the equity bubble finally cracks, capital will rotate fast and violently into tangible stores of value. That's exactly what happened in 1980. It's what happened in 2011. And this time, the setup is even more extreme. The gold to silver ratio is still hovering around 100.1, a level that screams undervaluation. In every prior cycle, that ratio snaps back, and silver doesn't just catch up, it explodes. But this time, the rotation isn't just defensive, it's desperate. The bubble is too big, the risks are too obvious. And with the Fed now committed to cutting rates into a debt spiral, the clock is ticking on dollar credibility. As Wall Street clings to its fantasy, silver is quietly building the foundation for the biggest breakout in its modern history. And what comes next? It could change everything we thought we knew about silver's price ceiling.
It's a great question. So, making this kind of prediction is a fool's errand. But we don't have to do that because of the model that I created. So I'll understand when credit markets are fracturing. I'll understand when the money markets are faltering. I'll look at credit spreads. I'll look at financial conditions, and it's not going to be something that's going to go, beyond my watch. But the most likely issue I see is that you could see this scenario play out. The Fed only cuts interest rates on the margin because Powell's fettered by inflation reports that really haven't even priced in the tariffs yet. So most of these, we had a very bad inflation report for the CPI, and then we had even a worse one for producer prices, just came out this week. But if you look into those two reports, they were services prices that were going higher. They were not things related to tariffs yet. The tariffs have yet to hit. That's going to be reported, in September and in October. So what if we see the market start to falter then, and that's a very seasonally appropriate period for it to happen anyway, simply because the market is anticipating rate cuts that just can't happen, and you get a sell-off. Then you might get a little bit of a reprieve until April, May of 2026, and then you do get your significant rate cuts, and then the long end of the bond market goes ballistic. That would be the more significant and more trenchant of the sell-offs. But we are so overdue. I mean, I just I cannot imagine this can go on much longer. And I'm saying this from someone who manages money, who reports his returns every month, and is verifiably long the market. But I without this model that I created, I wouldn't be able to sleep well. I want to know when those handful of oligarchs and autocrats that actually run this planet, and their minions and their cohorts, when they understand when this thing's going to crash, they start acting on it ahead of time before anybody else knows. But my model picks up on those arcane components. I'll see their footsteps and I'll go along with them. I'll do it legally, though, not illegally.
Michael Pento isn't throwing out fantasy numbers. He's looking at the data, the trends, and the math. And what it tells him is this. $500 silver isn't a wild prediction. It's an inevitability. We've reached the tipping point. The debt bomb is ticking louder. The dollar is losing credibility. Supply is tightening. Industrial demand is exploding. And the stock market is about to choke on its own excess. All of it points in one direction, up. The stars are aligned in a way they never have been before. Silver is simultaneously being hunted by investors, fleeing fiat, and devoured by industries building the future. And with physical markets drying up, premiums surging, and mainstream analysts finally catching on, the window to act is closing fast. This isn't about timing the perfect trade. It's about recognizing the tectonic shift beneath the surface. If Pento's right, and history suggests he is, silver isn't just going to rise. It's going to detonate. And when it does, the $50 ceiling we've all been trained to accept will be blown away. Because this time, it's not a speculative frenzy. It's a monetary and industrial revolution colliding in real time. So the only question left is, will you be positioned before the headlines catch up? If you found this breakdown helpful, subscribe now and stay ahead of the curve. And remember, this is not financial advice. Always do your own research and speak with a professional before making any investment decisions.